Holy smokers, folks. A couple videos to react to here tonight. One is very, very bearish. I mean, very bearish. The other is a little bullish because it involves everybody's favorite bull, Mr. Tom Lee. Hope you guys enjoy this as always. I appreciate you joining me. Whisper Jeremy in effect, outdoor Jeremy in effect. It's all going on, folks. All right, let's jump into this, and I want to share my opinion. If you guys want to share your opinion, do so down in the comment section. I'd love to hear from you guys, as always, about either of these videos.
In 2 months, so where do we go from here? The chart master says he's still a seller. Let's bring in Carter Worth of Word Charting. No, it's not the trash business. Sorry about
FedEx.
that. Carter, back over to you.
I get charter, but I've never gotten carting, but it's all good. Let's figure this out together. Carting can be a good business. Charting can be a good business, too. So anyway.
Horrible week for the S&P 500, by the way. Horrible week for the NASDAQ. I mean, you were looking at pretty much like 5% type moves for those indexes this week, which is insane. I mean, that's just absolutely ridiculous. The type of moves down this week. It was nasty for everything. Individual stocks, ETFs, index funds, 401ks, it doesn't matter. It's all got tore up this week.
Here is the S&P, and the sort of the happy thing is it has lent itself to technicals beautifully, right? We know that on the way up, it has failed at the trend line over and over and over, and on the way down, it's done the same thing. And in fact, down here, it's done the same thing. So it's not DCF, and it's not PEG ratio, and it's not enterprise value EBITDA. It is simply and only charts. I know people don't like to hear that, but that is the reality. And what do? We just broke down. All right, let's go forward and let's see what the next one looks like. And what we're going to try to do is drill down on this moment. So we have this very...
So when you're in a time period of mass uncertainty, which is obviously a time period like we're in right now, everybody's very confused. And if we're in a recession, we're about to go into recession, where earnings are going to be at. We've seen so many companies miss their EPS, right? And even guide down or not give guidance. When you're in those sorts of time periods, sometimes it gets hard for people to judge things off of fundamentals. So if you're having trouble judging things off fundamentals because you don't know where earnings are going over the next, let's call it, 2 to 4 quarters, then people start looking at technicals because they're like, crap, I don't know what's going on right now, honestly.
Precise minor uptrend line we have broken. And of course, if you were to look at this formation, we have all the elements of that minor head and shoulders top. Really, ultimately, I think we complete this and we get down to the low of 36.36, that is June 16th. That's about 5-6%, and you can see that on the next chart. Now, the real question is, and Grasso will raise this, do we go lower? There's every possibility of going lower. Let's look at a final chart and figure it out together. This is all data from the 09 low. So if you simply connect your financial crisis low with your COVID low, we've lived this entire channel until we blew out through the top when the excesses of last year. And now we're simply at the middle point. Do we get down into here? Do we get down into the middle or lower part of the bottom? And I think we do. So 3,300 is about where that comes into play, and why not?
But Carter, how about the...
So 3,300, when you're talking about that number, that's where we were prior to Rona. We were at about 3,300. So that's exactly what he's saying there, is going down to those sorts of levels. That would be a pretty nasty drop from here. You're looking at... Apple being down 15 to 25% if that was to happen. Meta would likely keep falling, and it's hard to even fathom that one falling more. But if we're going down there, that's taking it down. Google McDougal will drop another 10 to 15%. Mr. Softy would drop another 15% or so. Stocks like Nvidia and AMD, as bad as those have been hurt, and those stocks are down like 50% so far year to date. Nvidia is down more than 50% year to date. If we're talking about 3,300, you could be looking at Nvidia, down 60% year to date, 65% year to date. You could be looking at AMD down 65% year to date, which is just that would just, man, that's just devastating. That's all I have to say about that. But if we're talking about those sorts of numbers, 3,300, that's what you're looking at is for devastation, just nasty.
Shoot, Michael Hartnett from Bank of America Merrill Lynch out there today, a guy I respect, and he actually talked about the 35th anniversary of the 87 crash, and actually a couple key data points he's looking at that could take you really to 3,000 or 3020 on the S&P. Could that be an overshoot? And again, just the realm here.
So absolutely. If you look at that last chart, what you can do is just as we overshot through the top of the channel right here, you can overshoot to the downside. But before we get to 32 or 3,000, I think 33. And then I'll tell you, some very big clients talking mid to low 2,000s.
Wow. Mid to low twos. I mean, shoot. In order to get that sort of move, which is the doomsday scenario, into the mid to low twos, you need earnings to completely disintegrate for big tech. I'm talking Google, I'm talking Microsoft, I'm talking Apple, I'm talking Amazon, and I mean fall to pieces. Now, in order for that to happen, those sorts of companies, you need massive economic devastation. Then you're talking about, in order to get something like that, you would be talking about unemployment 7, 8, 9, 10%. You would be talking about massive businesses, massive amount of businesses going out of business. That would be an 08, 09 type scenario. I don't know if we get there, to be honest. I mean, everything's possible, but when you just look at it from the context of, the banking system's not set up in that sort of, let's just call it jeopardy like it was back then. So all things are possible, but gosh, man, But when you're in a raging bear market, which is clearly what we're in, it's a raging bear market where stocks have just been obliterated and continue to, right? You can throw out any number and it sounds plausible. It sounds like it's a possibility because the market just keeps going down and down and down, and then it goes up a little bit and then it just loses all hope and it drops again. When you're in that sort of market, at that point in time, anything, you can throw anything out. No different than when you're in a raging bull market, the stocks just go up day after day, week after week, month after month, and it's just glorious. You could throw out any price target on a stock and say it's going to this, going to that, the market's going to blah, blah, blah. And people will believe it, right? When the S&P 500 was hitting 4,700, 4,800, you had people putting out 5,500 price targets for the S&P and some even over that because you could do it, right? When the market was in that raging bull market. Now, when everything's in a raging bear market, now you can throw out anything. Hey, I think the S&P is going to 2,200, 2,500, and people pay attention because that it's just devastation after devastation, right? So, if I'm to look at it, I always think, everything's always a possibility. But if this upcoming earnings season was really bad and companies were really uncertain, I could see us going down to that, let's call it 3,300 level by early November. But you would need horrible earnings. You need Apple to come out and disappoint big time. You need Microsoft, Google. You need the big dogs just come in and just horrible, horrible, horrible. If all those big dogs report horrible, then 3,300's in the realm of possibility, folks.
2000s. All right. Thanks a lot, Carter.
There's going to be a lot of karting around at that.
Yeah, it's going to be a lot of. I might have to get into karting. All right. Thanks, Carter. We're going to see you back here in a few minutes for options action. All right. Let's just trade this. Jeff, again, I see out the corner of my eye, you made a face there when we got to those key technical levels. Was there something that caught you?
I'm always making faces.
Are you always making faces?
Yeah, half the time they don't mean anything. But
what happens if that's just his face? Now you made him feel self-conscious.
Exactly. No, but those levels are something that we've all been looking at, right? It was that minor upward trend line and then 3,900, closed below it. So problematic. But we're being so negative. Let me just, a little bit of sunshine here on a Friday.
Please.
And this is practical advice in dealing with, real investment committees. I chair an investment committee for a nonprofit. We're talking about putting cash to work. You are far more likely to regret putting cash to work when the market is up 20% versus down 20% if you have more than a couple of year time horizon. So just keep that in mind. Of course, the market can continue to drop. I think it actually will, but it doesn't mean that putting money to work now is the wrong decision for the vast majority of investors watching this show.
On average, the markets move up 10%.
That's a great point. That's the thing. Obviously right now it's very popular to try to time the market because everything's going down. So it's kind of like, what's the rush to get in? When everything just goes down and down and down day after day, week after week, people start thinking like, oh, it's just going to continue to go down. Why do I need to rush into stocks? Why do I need to buy, Google stock when it's down 28% year to date, just using Google as an example, right? Because Google might be down 33% or 38%, a month from now or 2 months from now. It's always a possibility, but, we don't know. So that's when you kind of get in the timing thing. But at the end of the day, when it comes to a lot of these stocks, it's like, you could try to play the timing game, but you might miss it. And, usually when it looks really, really bad, that's when things start to flip. So, as things get worse, earnings get worse, you get closer and closer to flipping. That's just bottom line. The worse the economic numbers continue to get, the more likely inflation is going to continue to come down because commodities will just continue to get destroyed. Never mind, they're going to have to comp against these comps. We've had a comp, at these numbers we've had this year, which is going to be, not too easy. And then you get more and more realistic about the Fed either not raising rates, or potentially cutting rates in 2023, right, as kind of time plays out there. So, there's just so many factors. At the end of the day, remember you're buying a business. Remember you're buying ownership of that company.
annually since the beginning of markets. But the truth is, I'm negative for the next 2 months. I think that midterm elections are going to be the catalyst for the market to rally in the last 2 months of the year. But I do think we could see some of these much lower levels that really tests everyone's moral fiber.
All right, so really quick, Tim, I'm going to get over to you, but you're saying they're going to rally. So you're forecasting gridlock. Generally, gridlock creates that rally.
Gridlock in the last 2 months, but I think the next 2 months are going to be a little bit tense, and we could see that 3,300 level in the S&P.
I go back to where positioning is and also where you actually see sentiment right now. It's terrible. And you look at consumer confidence. We had the University of Michigan out there today, slightly better than expected, but still well below those COVID lows on the University of Michigan confidence. So I just think that the market is prepared on some level. I think this move has been seemingly almost in slow motion when you consider all the things that we've been assessing over the last 18 months. I think you have to be patient as an investor. This isn't going to happen overnight. And in fact, I think you've been given enormous trading opportunities. You've had 9 or more plus or minus 8% moves in the S&P this year. And I think you're going to continue to get those. And again, we've had a major pullback. I think we are, as Jeff said, in a place where there are stories to be bought out there. There are companies we're going to give you in a little bit. There are also ones that I think you can sleep on. But it is time to be finding the best companies in the world. I can own Google here. I can own Apple here. I choose not to be. But I think there's a place where a lot of investors want to know what they can start adding.
Right. I think that might be true in tech generally. Tech, obviously, a moment of capitulation. A lot of those big tech companies, we talk about cloud. We're talking about software names down 50%, 80% from their high. Are those the kind of groups you're talking about that all of a sudden they're not as expensive, they get a little bit more attractive?
Well, look, we talked about this yesterday when we talked about Adobe. Software companies, I think, continue to be a place where the multiples are tough to justify. But when you look at companies that are both have some cyclicality and are kind of hitting some of those headwinds, but we haven't heard the pullback in cloud. That's the one thing that I'd be most worried about with Microsoft and Google, who have a lot of exposure there. But again, Google at 17, 18 times with a PEG ratio kind of 1 or less. That's a company that's priced pretty attractively here, and I think you can own it.
Yeah, and with Google, there is a little potential government problem, so do keep that in mind, and that's what's part of the reason, the stock is down, let's say, more than Apple stock. People are thinking about that, pricing that in, and just trying to figure out if it's going to get a bunch of bad publicity similar to what Meta got a few years ago. So do keep that in mind. Okay, so that was obviously very negative stuff there. All righty, Mr. Tom Lee's here. So now we get a little bullish, okay? Both sides of it, all right? By the way, thank you for everybody that subscribed to the channel. I think, we might hit 12,000 subscribers in a few days. That's crazy. So thank you for everybody that subscribed to the channel. I appreciate each and every one of you. Much love as always.
Though sticking to his case for a year-end comeback, CNBC contributor Tom Lee. He's the head of research at Fundstrat Global Advisors. He joins me now. Tom, I have to admit, when I have you on, people say, why you keep having him on? He's too bullish. He says the same thing about being bullish every time. And I say, I got to have you on because everybody else is negative. So we got to press the case and find out how you can remain so bullish for the remainder of the year in the face of what is overwhelming negativity from most. How do you? How do you stay positive, thinking that stocks can still do well when most others think they cannot?
First off, that was just a good setup. That was just a good setup. I love that.
I think that a lot of this has to do with, I don't think the right word is myopia, but I think investors have what I call recency bias. That we've got really bad inflationary data now, and we've got negative price momentum. And in that combination, investors basically are negative, but they can't necessarily see how things can inflect. And I think one of the most important inflections that has already taken place, but the second leg comes early next year, is that inflation has peaked. I don't think the August CPI report has changed that. And if you look at what the bond market's saying, it's saying that by the middle of next year, inflation using swaps is going to be around 2.5%. So we're talking about inflation dropping from 8% today to 4% early next year to 2.5%. And that means the Fed's, in terms of hiking, is going to be done sometime early next year. That didn't change with the August CPI, though. Maybe the level of hikes that we're getting into, but the data, those peaks, isn't changing. And what I think is the most important is when the Fed is sort of vanquished inflation, and even Alan Blender said, this is kind of a young inflation, not going to take decades to fix. Then corporate America is emerging from a time where they survived COVID and didn't see profit margins collapse. And then they went through a 2-generation level of inflation never seen, and then they survived. To me, that's going to be taking out a huge tail risk out of equity risk premium. When we see markets convinced inflation is broken, PE is going to go up dramatically. And I think that that's the mood change that's going to take place. We actually think it could happen as early.
Okay, that's a thought process I bet you 99.99% of investors have never even thought about. I mean, I hope everybody understands what he just explained there, essentially, right? So you had a situation where you had a once-in-a-100-year health event. The whole worldwide economy got shut down. That was literally pretty much worst-case scenario you could possibly imagine, right? Then you got that followed up with, obviously, Russia, Ukraine. You got that followed up with commodities go through some bull cycle we've never seen. Inflation go to the highest since pretty much the 1970s, right? And you've had all this scare, all these things happen, right? And I do think he has a point that when the market starts to come back and earnings get back on track and those sorts of things, right? Geez, it's going to be maybe less of a fearful market than we've ever seen in history, because you've made it through two unbelievably dramatic bad times and made it out to the other side, right? We still got to make it out to the other side of this situation, but once that happens, it definitely makes you not as fearful. And that could potentially, I don't want to get too excited about what he said there about, multiple expansion, but it's not out of the realm of possibility. So I think his thought process there, rewind that if you need to hear that again, that was extremely important. Like I said, 99.9% of investors never even thought about that. That's a interesting, out there, high level thought.
The October CPI, which is in a few weeks. So yes, we are sticking to our constructive view, but again, I think we're trying to look past this recency bias.
Yeah. Speaking of recency, FedEx, that doesn't give you any sort of pause that it's a canary in a coal mine, that it's the first of many to come out and warn, and therein lies the biggest problem?
Scott, you always have to pay attention to transports because they're a pretty good real-time and early sort of barometer of economic activity. But I just think we've got to mitigate that in three ways. Number one, FedEx pre-announced it's down 20%. And on the day that it pre-announced and it's down huge, the market's down kind of in line with some of the weakness all week. It hasn't accelerated the sell-off. Secondly, we don't really want FedEx to announce upside surprise to earnings because I think then you'd see markets raise up their hands again and actually raise Fed expectations. In fact, we saw the 10-year kind of cool today. So from a timing of what happens next year, it's actually a good thing. And I think the third thing just to keep in mind is, FedEx, and there's a lot of commentary about that today, it shouldn't be a surprise to the extent that they did build up a lot of capacity into this year. And we've got a slowdown in the rest of the world. And, if investors think that you got to take down earnings for the market because of FedEx, that might be true, to some smaller beta. But they're forgetting that the PE is going to change dramatically when inflation risk is taken out of equity risk premium.
That's a potential. The other potential in terms of PE is whenever the Fed potentially cuts rates again, which who knows when that is. So don't get too excited about that anytime soon. But, something that's definitely hurt the market is the way a lot of investors value stocks in a higher interest rate environment. Some will basically take whatever the interest rate number is and kind of use that into their DCF models and those sorts of things. And obviously, a lot of people don't even do that, but some folks do. And so those folks value stocks differently in this sort of environment, right? So yeah, there's many kind of factors at play there. I think it's a very easy time to pack up camp and just be ultra bearish. But, I like obviously Tom Lee's kind of optimism, and I also like the thought processes around, focusing on the long term because we will get through this mess. We always do. Maybe this is the one time we don't. But, when I brought this out in the video I did in the main channel many hours ago, I brought out the point that, every single dip, every single crash in stock market history has been a huge buy the dip opportunity. And within a couple of years, you're usually very happy with yourself and the fact that you were buying in a massive crashing year. And we're in that year this year. And, we'll see what transpires. It's likely going to be shaky ground for the next few months. And we'll see what happens with, obviously, earnings. The good news is when it comes to companies, if a lot of companies, let's call it, are very negative on their commentary, miss numbers, they'll put the analysts in a situation where they will, not have very optimistic 2023 numbers, which could be very helpful to companies because, you don't want 2023 numbers being too optimistic going into 2023 in a shaky environment. You'd rather have things be a little more uncertain there and lower numbers, and then hopefully companies can come in and kind of beat those numbers as 2023 goes along. And especially if the inflation problems subside, if consumer confidence starts coming back a bit, and the Fed stops going crazy with the raising of interest rates and things like that. So, it's just, time has to play out here. People get really excited about, I think the stock market is going to bottom next week or next month or those sorts of things. And, as I've said this entire year, you got to be ready to fight this fight till the end of the fight. And it's a 12-round fight. It's a 12-month year, and you got to be ready to fight this thing till the end. And that's just kind of my perspective on that. Don't get too excited too early. Buy the dip, buy great companies you love at great prices, and eventually the wall of worry will be fully torn down, and we'll move from there. So anyways, guys, much love as always. I appreciate you joining me. If you're looking to join my private stock group, get access to everything in there this upcoming week, the Discord chat, the course curriculums, access to myself and the other investors and those sorts of things, check out the pinned comment down there to apply. Much love and have a great day.